Hello again everybody, doing it from DRFX, Forex and Trading. Well, the Euro US dollar trade is provided a gain of 46 pips, much less than the 165 pips that we were aiming for, but again, a trading gain nevertheless. Overall, this pair was expected to rally towards the resistance boundary and actually hit the boundary following this ABC reversal setup to take us back inside of the range consolidation. This boundary, the resistance of the range setup that formed part of the ABC setup was actually broken with this large candle. However, it was followed by a normal candle which we can trade, and also this U-turn bullish engulfing candlestick formation as well. So we were essentially trading this second candle following this initial candle here. So the holding period for this type of trade, which is 5 days, is actually measured from the first candle following this normal candle. We would ignore this candle, this large candle. This normal candle is the one that basically legitimizes the trade, so to speak, and justifies entry. So the 5 day holding period for this trade will be measured from the first candle after this initial signal. So 1, 2, 3, 4, 5 today would have been the last day of that holding period. So we were actually entering at the third day of the holding period. So this was the exit for this trade. The market could actually hit the resistance boundary within the next couple of days, but we have to obey the 5 day holding period rule for all our trades. This was expected to move pretty quickly because the consolidation setup on its own, combined with an ABC setup which also leads to fast breakouts, both of them were expected to move quickly towards the resistance boundary with very little hesitation. So even though the market is moving pretty quickly, we would have expected it to have hit the target, the resistance boundary by now. So the market could be slowing down right now as it approaches this resistance boundary. There could actually be the start of selling pressure as the market approaches this area here. So a small trade, but nevertheless a trading gain nevertheless. Now let's take a look at the 4-hour chart and see what took place after entry. The stop loss was placed below this ABC area here at 11:55, and as you can see, the market came very close to actually taking up the stop loss, coming around 5 pips above the stop loss area. So this was a very close call, and this was a very strong pullback. But following this pullback, the market eventually rallied once again and carried us higher, allowing us to be able to exit at this area here. This is one of the reasons why we never look at our trades while they're in motion. There will always be pullbacks and waves along the way as the market moves towards our target. These can tempt us to exit our trade, especially when we start to see the market pulling back towards our stop loss. But these are the things that happen from time to time, where the market will come very close to actually hitting the stop loss, and then U-turn at the last minute to then move towards our target. So that is why it is very important to avoid looking at the charts while the trade is in motion. There are times, of course, when the market will pull back and stop us out, and monitoring the chart and looking at the chart and being able to exit the market before that actually happens can save us some losses. But that is a bad habit to to get accustomed to, especially when it comes to these type of situations where you would basically be self-sabotaging your trading profit, your trading profitability. So that is why every time that you trade, once you have entered a trade, you should never look at the chart until the trade has been closed. So right now we're starting to see the market show signs of weakness with these small tweezer tops. Tweezer tops are generally an indication that the market is starting to slow down and is going to pull back. So we could actually see the market pull back with a bear candle at this area over the next 24 hours. So the market could start to pull back in response to a buildup of selling pressure at the resistance boundary. Nevertheless, as long as the resistance boundary has not yet been hit, it is possible that the market could still rally and actually head towards this boundary and hit it over the next couple of days as well. So that is also possible for this market. So technically speaking, our trade would have been hit and we would have been able to get a 165 pip gain, but rules are rules and holding period rules are holding period rules, and we have to obey that. So even though we might miss out on this rally that could provide us with another 100 pips, we have to obey and what's the word? Be content with the small profits that we capture along the way. So a trading gain that could have been the total opposite if the market had actually hit our stop loss. So another reason why we need to not only not monitor our trade, but also ensure that when we're placing our stop loss, it is at the right area and comfortably below the low or comfortably below the high when it comes to a short position. So a very close call, but very grateful to be able to get this small gain of 46 pips. So just to summarize this trade, the overall trade itself was a false breakout ABC reversal on the daily chart as the market returned inside the large consolidation setup. This was expected to hit the resistance boundary and actually provide us with a gain of 165 pips. But within the holding period of 5 days that's established for this type of trade, we had to exit our trade for 46 pips. Just over 100 pips less than our original target. Monitoring of trades is never done, and the pullback that we saw on the 4-hour chart confirms or proves why we should not do this, because we can be easily tempted to exit our trades prematurely just by pullbacks that we see taking place. But as with this trade and as with many other trades in the past, the market can come very close to actually taking up the trade, but can U-turn at the last minute and actually head towards our target. So that is why it's never a good idea to monitor our trades while they're still open. Correct stop loss placement is very important in these types of situations as well, because the pullbacks will take place, and as long as our stop losses are comfortably placed at an area that generally would not be affected by these pullbacks, then we can enjoy our trading gains without being stopped unnecessarily. So a small trade, but again, nevertheless, especially in light of the fact that we could have been stopped out by that sharp pullback. So we're gonna wait to see what takes place at this area here. The market could actually rally and hit the resistance boundary, or it could pull back in response to the buildup of selling pressure that normally takes place at these areas, and in response to these small tweezer tops that have now appeared.